Inflation in the United States slowed in April after 7 months of relentless gains. It's a sign that price increases may have peaked. The findings by the Labor Department show underlying monthly inflation pressures are building up again after a lull in March as airline ticket prices notched their biggest increase on record. Rents rose to their highest since 2006, further squeezing consumers who also paid more for food and healthcare. While the country's struggle with high inflation isn't over, economists are saying it's likely to not get any worse. That's at least a positive. Joining us live now is Evan Lucas, the Chief Market Strategist at Investsmart, to get his thoughts on this. So inflation continues to move ahead. Evan, what does this mean for the June Fed meeting and also the markets?
Yeah, so that's probably the best question at the moment. It's a certainty, therefore we'll get 50 basis points of rate rises, so 0.5 of 1% will increase. We have been told that Jay Powell has been basically out front foot saying that. The question that the market was asking again last night is whether or not he's completely written off the idea of a 0.75 of 1% rate rise. And it was, although you just highlighted it has slowed, it is still near a 40-year high. Headline inflation was at 8.3%. What they call shelter costs, which are not just rents, but the whole gamut that is housing, that was actually rising at the fastest rate since 1991. And the food prices in the States are also at the fastest pace they've seen since the 80s. So there are still big concerns. So the market's reaction is, again, that prospect of a higher than expected interest rate and a faster and steeper rise towards what they believe the neutral rate is could now still be on the cards. And therefore, after the US markets looked like finally breaking out of what has been an incredible decline over the last 3 weeks, again went backwards. They were up around about 300 points. The Dow finished down, the S&P finished down, and the Nasdaq got absolutely pummeled last night, down 3.2%, to go on top with a 27% decline they've seen since the peak on the 3rd of January this year to where we are now. So they're below 30% off.
As we know, Evan, just about everything is affected and a lot of things suffer because of inflation. But if you were to single out one thing, what suffers the most during high inflation?
Discretionary spending. And that's already been seen in the data that we came out last night from the US. It's been seen here as well. If you are told that you are going to have to tighten your belt, the first thing to go is discretionary spending. And that's a whole range of things. It's not just, clothing, etc., or high-end fashion or whatever like that. It's actually, basically things like going and getting your, lunch at a cafe, or it's going out for dinner, or it is going and doing that travel you wanted to do, or even as simple as going away for the weekend. They're the things that suffer the most the first. And you always see it the first. And they're the industries that have suffered the most over the last 2 years because they were taken away by the pandemic. So that's the catch about what's going on right now. It's just another hammer to those businesses in those areas that are likely to see a decline. And as I said, you've already started to see it. If you have a look at discretionary spending in the US in April, it is starting to fall. If you look at intentions in terms of consumer confidence yesterday from Westpac, they showed you that their forward and 12-month view around their economics is falling. So that shows you that's where it starts. It's always the first thing because the 5 things we can't do without always stay: energy, food, fuel, which is transport, health, and education. They're the 5 things that remain solid no matter what in an inflation or a high or low. So that's where it comes. It's discretionary spending.
Okay, Evan, good to explain that. Thank you. We'll talk to you soon.